Hello friends, now we are taking the second part of our approach from corporate issuer capital structure learning module, same LOS 3, that is explain the Modigliani Miller propositions regarding capital structure. So now what I am going to do is the second part of theory, that is with the taxation. Again we will go through the complete theoretical aspect, what are the formulas, graphs, and then we will do a practical numerical question with steps, and these steps can solve all type of theory with taxation question hopefully in the exam. So we will create a standard set of steps from which you can solve the question. So let's start with the with taxation, assuming that you have already covered without taxation, assumption of approach, and the both proposition 1 and 2 of without taxation. What we have already done in case of without taxation, the first proposition is related to valuation and WACC, and the second proposition is related to cost of equity. Same sequence we are following for with taxation also. Proposition 1 is related to valuation of firm and WACC, and second is related to cost of equity. But with a change, that is now there are taxation, that is taxation impacts, that is now here we are talking about income tax again. So let's go for this part, the second part, that is with the taxation, what it says. Let's first read the proposition, what this theory is saying, then I will explain. First, presence of taxation. Now we are having taxation in the income statement. So presence of taxation increases the value of a profitable company, increases the value of a profitable company due to debt. It means as you increase the debt in the capital structure, value of firm will also increase. It means a levered firm will always have a higher value than the compared to the unlevered firm. Higher the taxation rate, even the tax rate if it's increased by government, higher the tax rate, the greater the benefit of being debt in the capital structure. So both debt and tax rate are having positive relationship with the valuation. So if any of these two increases or both increases, your value of firm will also increase. So it means now capital structure is not a relevant decision. You have to take it very consciously. Because this is going to impact the overall valuation of the firm. So now what is the formula of valuation of a levered firm and unlevered firm? VL is equals to VU plus a T multiplied by D, where T is your income tax rate, corporate income tax rate, and D is your market value of debt. Now from where this formula is derived, that is not in our study mat, but still I will solve because these are only 4-5 steps. Now next, the presence of tax. Now why levered firm valuation is higher than unlevered firm? In the earlier approach, without tax, we because of arbitrage, VL will be always equals to VU. Value of levered will be always equals to value of unlevered. So why there is an additional T into D, the second expression in the right hand side? The reason is with the tax. Both U and L are having same EBIT. The cash flows are same. Cash flows are same. But because of taxation, both are having, U and L are having same EBIT of, let's say 200, and then we will subtract interest. Let's say there is a debt of 500 at the rate of 10%. So there will be a 50 rupees subtraction of interest in the company levered, no subtraction, no deduction in company unlevered income statement. We do not have that derivation, but still just a 2-minute work. So EBIT is equals to, in this case, as 200, whereas here it is 150. Next, we are going to subtract taxation. Taxation, let's say it is 25%, or let's say 30%. So this is 30%. This is going to be 60. This is going to be 45. So when I subtract this, the equity earning after tax is 140 in this case, and here it is 105. Do not think that U company's shareholders are having benefit. No. Why? Because U company, the 100% amount is invested by equity shareholder, whereas in case of L company, maybe let's say it is having a capital employed of debt of 500, here 0, and equity is of 1000, so here it is only 500. Both companies are of same level of risk level class and same industry and same EBIT, so they must be having same capital employed, so same asset level, so same capital employed. So if I say U company, here the ROE is 14%, return on equity is only 14%, whereas here it is 105 over 500 is equals to how much? 21% somewhere. So in percentage term, of course, L company's equity shareholder are beneficial. They should be, because your ROI is your 20%, your EBIT over capital employed is 20%, 200 on the investment of 1000 is 20%, and your interest rate is only 10%. So your leverage is beneficial, favorable. So again, going back to the theory. Now what we see there, that there is a cost of 50 rupees, but at the same time, there is a benefit of 15 rupees. There is a shield. Tax shield on interest cost. Tax shield on interest cost is received by company L, and this shield will be received every year till perpetuity. So equity holders are, this company L company is having an additional advantage of 15 rupees, which will be distributed to its investors, debt and equity combined, till perpetuity. So when the investors, in case of you, the after taxation 140 is going to investors, only equity investor is there. But in this case, in case of the U company, your debt plus equity investor are getting 140, but here it is, they are getting 105 plus 50, that is 155. 15 rupees is the additional what they are getting. 50 rupees is the interest and 105 is being paid or generated for equity holder. So company L is generating, with the same assets, it is generating 15 rupees additional till infinite, till perpetuity. So of course, value of U should be lower than value of L. Or I will say value of L should be equals to value of U plus something extra. What is something extra? Present value of future cash flows. This is the simple rule of valuation. Valuation 3-step. Find the future cash flow, find the required rate, discount future cash flows with that required rate, and that sum of present value is the value of that asset. So for business L, the valuation will be equals to value of U, that is 140 they are also generating, plus the present value of that 15 rupees. And what is that 15 rupees? 15 rupees present value of tax shield on interest cost. And this is an infinite perpetual constant series. So VL will be equals to VU plus, and how to calculate interest cost? It is D into T. How to calculate D into I percent? How to calculate tax shield? It is into T. So how to calculate present value? It is a T percent multiplied by D multiplied by I percent over I percent, the present value. For the present value, we will divide it by I. The perpetual constant cash flow model, present value of that perpetual constant series, we have to divide it by I. So this I and I will get cancelled. So VL is equals to VU plus that T multiplied by D, what formula we have in our course. We do not have this derivation. Ultimately, we are using this formula. So let's get back to the theory part. So what is the theory saying? Theory says that VL is going to be higher than VU by T multiplied by D. And if T is increasing, VL will increase. If D is increasing, your VL will also increase, under the assumption that there are no bankruptcy cost, agency cost, financial distress cost. That will be improvised in next theory, static trade-off theory. I'm repeating this because this may be one of the MCQ. So, in the presence of corporate taxes, the value of levered company is greater than that of all equity company by an amount equals to the tax rate multiplied by T multiplied by the value of debt, defined as the present value of the debt tax shield. Tax shield is received on interest, not of course on debt amount, but the present value of tax shield on interest on debt, we may say. Proposition 2, first of all, so value of firm we have arrived. Now proposition 2, what proposition 2 says? If I see this graph, let's see this graph, what it says, the debt equity is there in the x-axis. You denote your unlevered. For unlevered firm, originally without taxes, red line and purple line, and with taxes is green and blue line. Without taxes, RO was constant. RO was constant. WACC was constant because the benefit of cheaper cost source debt is getting exactly offset by cost of equity as per without tax. So RO will be constant. Introducing debt will get a benefit of lower cost source, but KE will increase, your cost of equity will increase. And cost of equity is a linear relationship. Formula is RE is equals to RO plus RO minus RD multiplied by D into T. This we have derived in the last part. But with the introduction of tax, now we are getting the tax shield advantage also. And the cost of debt is also going to change to after tax cost of debt in case of WACC calculation. Cost of debt RD, rather than using RD, we are going to use RD multiplied by 1 minus T. Cost after tax cost of debt in case of WACC calculation. So your RO, as you increase the weight of debt, your RO will come down because of the benefit of tax advantage. That is why the blue line, that is RO with taxes, WACC with taxes, is sloping left to right downward. But introduction of debt in the capital structure is going to increase the risk of equity holders, so they should be rewarded more. They will ask more reward. So their expectation will increase. Of course, your cost of equity should slope left to right upward, which is there, but that increase will be at a slower pace. That is why that green line is lower than the red line. Cost of equity with taxes is lower than cost of equity without taxes, because there is an extra advantage which is getting passed on to equity holder. So their risk is getting reduced. That is why their expectation is increasing, but at a slower pace. So graphically we have understood. Let's see what proposition is saying. If the cost of equity is a linear relationship, which is of the company's debt to equity ratio, because we are not using any other type of factors, financial distress, agency cost, etc., with an adjustment of tax rate, then following is true. What are the true situation? First, the presence of tax. The cost of equity rises as the company uses more debt because risk is increasing. The cost of equity will rise, but at a slower pace because they are getting extra advantage of tax shield on interest on debt. As the company uses debt, its WACC decreases. RO will decrease because of benefit of tax advantage. And since WACC is decreasing, cash flows are constant. Your 200 rupees EBIT is constant in U and L, but your WACC is decreasing, your discounting rate is decreasing, your present value will increase. So value of levered firm will be higher than value of a unlevered firm. That is what the conclusion of this theory is also. In the presence of tax, and of course the assumption is there are no financial distress, which will be improvised in the next theorem. The use of debt is value of enhancing. Use of debt is value enhancing because we are getting tax advantage of that 15 rupees extra amount. And at the extreme, theoretically 100% debt is the optimum. So first of all, without tax says, approach without tax says capital structure is irrelevant. VL and VU will be same. You can keep any capital structure. But now with tax changes instance. What it says that with the debt, your valuation will increase. So the best position of capital structure is to use theoretically 100% debt. That is the optimum point of the capital structure. The cost of equity will still rise as the company increases the amount of debt in its capital structure, but it rises at a slower pace in case compared to the non-tax that we have already done. So let's go for the numerical part, how to solve numerical questions step by step, and we will use that same illustration what we have taken for without tax. Same illustration we are going for that. But now there is a change, that there is a taxation. So let's go for that illustration. Illustration again, both companies A Limited and B Limited. A is levered, B is unlevered. Both are generating cash flow, that is EBIT, from its business, 18 lakh and 18 lakh, same risk class, same risk class. So overall risk, operating risk, sales risk are same, but leverage is increasing, DFL is increasing in case of A Limited. 12% debt they are introducing. Question may change that in this way, that company B Limited is an unlevered company. It is generating a cash flow of 18 lakh with a cost of capital of 18%, and now they are thinking to introduce a 12% debt of 54 lakh. What will be the impact on WACC? What will be the impact on value of firm? What will be the impact of cost of equity? Same question with the different way they can ask. Here I have given two companies. They may say that it's the B Limited is the original company. There is no A Limited. Now they are moving to debt, introducing 12% debt of 54 lakh. What will be the impact? So same calculation will be used in that type of question also. Next, determine as per approach with 40% tax. We are going for 40% tax. Again, both market values, both cost of equity and both weighted average cost. First, the cost of equity they have to give at unlevered position. Otherwise, we will not be able to start the question. So that will be always available. We will be always given with your cash flows, that is your earning before interest and tax, available for your both investors, level of debt, rate of interest, tax rate, and the cost of equity in case of unlevered. These five will be always given. Otherwise, we cannot start the question. So five information if we have, we can do all these steps. So let's start the step by step. First, valuation will be done. As I have already told, in case of without tax, valuation will always start with unlevered. Then it will go to levered part. So unlevered case, step number 1. With the taxation. First of all, make the income statement. Income statement A and B. Your EBIT or free cash flow is 18 lakhs. Less interest, 54 multiplied by 12% is equals to 6 lakhs 48,000. Here nil. So EBIT is equals to 1152,000 and 18 lakhs. Now you have to pay taxation at the rate 40% because here we have tax. 4,60,080. It 691,920. Let us check it again. 48. I have done some mistake. This is 1152 into 0.4, 460,800. So this is going to be 200. 691,200. In case of 18 lakhs, 720 tax you have to pay. Negative. So net is 1080 is the earning after tax for your equity holder. Let's start with the step number 1. First, we have to make income statement to find out what the equity holder of unlevered firm is going to get now. Earlier, in case of without tax, we need not to make this income statement. Why? Because EBIT will become your EBT because there is no interest and there is no tax. So it is the ultimate income going to the equity holder. So there was no requirement of going for income statement. Now we will need this. So step number 1, income statement here. Step number 2, now valuation. Valuation will be first done for unlevered part. Unlevered company B Limited. What its shareholder are going to get? 10,80,000 forever. and their cost of capital. It's their shareholder are going to cash flow for shareholders are, there are no debt holders, it is 1080 till infinite. And the cost of equity question already gave us, and it is also equals to WACC also, it is 18%. I think 18 was the number given, yes, 18%. So in this case, value of firm B Limited, that is VU unlimited unlevered, is equals to 1080 000 divided by 80%. We are using perpetual constant cash flow model of time value of money, assuming that this 1080 will be received till infinite, the same amount, constant amount will be received till infinite. So we are discounting it to T0 to find the value of the series. So this is going to give 1080 divided by 18% is equals to 60 lakhs. If I compare it with the without taxation, the example what we have used in the last video, the valuation of unlevered company, the valuation of B Limited was 1 CR, 1 crore. But here now the valuation reduced to 60 lakh because of the impact of taxation. It is not comparing levered versus unlevered. We are not comparing levered versus unlevered. We are comparing the value of unlevered B Limited without tax 1 CR, with the tax 60 lakh, because now shareholder are getting impact of 40 lakhs in their earning because of the taxation paid to government. So they are reducing the value of the company. Now we have got the value of unlevered. Now we will do the valuation of levered. Valuation of levered is equals to valuation of unlevered plus T into D, the formula what we have already derived. So valuation of levered, that is valuation of firm of A Limited, is equals to, now we are doing the valuation of overall firm, debt and equity combined, is equals to 60 lakhs plus 0.4 multiplied by your debt of how much, 54 lakh, I think 54 lakh 54 lakh is equals to, the overall value will increase, 54 lakh multiplied by 0.4 plus 60 is equals to, now overall value increased to 81 lakh 60,000 because of introduction of debt in the capital structure. So capital structure is impacting the overall value. So as you increase the debt or government increases the tax rate, your value of firm will increase. So for a issuer, the optimum capital structure is that point where the valuation is maximum. So to maximize the value, you should maximize the debt, and the maximum level of debt theoretically can be 100% of the capital employed. So that is the optimum capital structure as per this theory. Now we have got the valuation of the overall firm, valuation of overall firm. Now we have got the overall firm valuation. Now calculate step number 3. Value of equity in both the firms. A Limited, that is U company, and B Limited, that is L company. Your value of firm, here it is 81 lakh 60,000 and here it is 60 lakhs. Subtract value of debt, here it is 54 lakhs, here it is nil. I have used wrong symbols. So A is our levered company and B is our unlevered company. So value of equity in this case, the value of equity shareholder security in this case will be equals to 81 minus 54 is 27 lakh 60,000, and in this case it will be 60 lakhs. This is not true in actual practical world because of the assumption used by this theory, but still this theory is relevant. Why this theory is relevant? Because at least this theory is giving us base to start something. So there are more theories which will improvise the assumptions what are used in this theory. So now we have got the value of equity, value of debt, value of firm, and that was the first question. First question is calculate the total market value 60 lakhs and 81.60 we have. Now cost of equity. Cost of equity is now what is the cost of equity? Step number 4. Cost of equity. First, cost of equity for unlevered firm. That is already given. Equity capitalization rate KCE for B Limited, the unlevered firm is already given 18%. Now the question is, what is the cost of equity KCE for A Limited, the levered firm? Now we need a formula. As we have derived this formula, some formula we have derived, I think, for cost of equity here. Yes. For M without taxes. This is for without tax. Same way we can arrive at the formula for MM with the tax, and in that case cost of equity RE will be equals to RO plus the overall cost of unlevered firm. That is only we have, because levered firm overall cost we have still not derived, plus RO minus RD, the cost of debt, multiplied by 1 minus a tax, the effect of tax shield, the benefit of tax shield, because of which your KE will reduce, multiplied by D by E. This formula is for MM with the tax, cost of equity, that is equity capitalization rate calculation will be done using this formula. We can derive this, again we do not have that in our course, so let's stick to the part what we have to study for the exam. So cost of equity is equals to, in this case it is equals to, it has one more additional formula, one more additional item in the formula, that is RO plus cost of unlevered plus overall cost of unlevered plus RO minus RD, that is cost of debt, into 1 minus T, that advantage of tax shield will reduce the cost of equity also, multiplied by D into T. Complete derivation we are not going for this, we are directly using this formula. So let's use this formula. What is the formula? RE is equals to RO plus RO minus RD multiplied by 1 minus T multiplied by D upon E. This is the ultimate formula. This is cost of equity. This is overall cost of unlevered firm. This is cost of debt, income tax rate, and these are market values of debt and equity respectively. That we have already derived. So let's use this formula. The formula says that KCE, that is your RE is equals to RO plus RO minus RD multiplied by 1 minus T multiplied by D upon E. So let's use these number. This is RO is equals to, this is also equals to WACC of B Limited, because B Limited is an unlevered company. For unlevered, WACC is equals to cost of equity. So they are same. So this is 18 plus 18 minus 12 multiplied by 1 minus 0.4 multiplied by debt is 54 lakhs. Whole divided by equity. Now equity is only, we have already calculated in step number 3, 27,60,000. So let's find out what is the cost of equity. Cost of equity is 54 divided by 27.6 multiplied by 0.6 multiplied by 6 plus 18. It is equals to 25.0435%. And if we check the cost of equity we calculated in MM without tax, it was also equals to 25.0435. Same cost of equity is there, but what we studied, that because of tax your cost of equity should come down. The graph says that cost of equity should come down. Where we have done this graph now, the second graph, the green line, the cost of equity of MM with tax is below the red line, that is cost of equity without tax, but they are coming same at the same debt level, 54 lakh. Then why this graph is showing green below the red? It should be the Same line. No. Why? The reason is debt equity. It's not debt which is used in the x-axis. It is debt equity. For red line, the debt equity ratio was 54 lakh on 46 for unlevered, for without tax. But now it is 54 lakh on 27.60. It's 27.60 for with the tax case. So they are not at the same point on the x-axis. They are not on the same point on the x-axis. So for unlevered it is 54 on 100, whereas in case of levered it is 54 upon 27.60, will be much ahead of that level. So that is why here and here they are same at 25.04. If this is 18 and this is 25.04, this level which is going down is, in case of without tax, is 54.10, and this level which is going down is 54 upon 27.60. And this in case of cost of overall cost, in unlevered, in without taxes, overall cost is always same, 18%, but now overall cost will also come down. The blue line is below your purple line. The overall cost of capital is below the purple line of overall cost of capital without tax. Let's check it out. So KE, both we have got the valuation of both the firm. We have got the valuation of equity of both the firm. So these are the steps. First, calculate the income statement. Second, find the value of both the firm. Start with the unlevered, and then go for the levered as valuation of levered, which is equals to value of unlevered plus T into D. And then step 3, calculate the value of equity by reducing the value of debt from overall value. Step 4, calculate cost of equity. For unlevered, cost of equity and WACC is same, but for levered firm, it is RO plus RO minus D, 1 minus T multiplied by D upon E. That is going to give us cost of equity. Next, step number 5, calculate after tax, because in case of WACC we have to calculate after tax cost of debt, which is equals to RD minus multiplied by 1 minus T, which is 12 multiplied by 1 minus 0.4 is equals to 12 into 0.6. 12 into 0.6 is 7.2%. 7.2%. Now calculate your WACC for both the firm. WACC for both the firms. First, unlevered, that is B Limited. WACC is equals to weight equity, cost of equity plus weight debt into cost of debt KD multiplied by 1 minus T. In case of unlevered, your WACC is equals to your cost of equity, which is 18%, nothing to do. But for levered, now we have to put data. A Limited, it is weight of debt equity 27.60, I think, yes, upon total value 81.60. This is the weight. Total value, weight is weight of debt over weight of overall firm, and overall firm value is not 60 lakh, it is increasing, multiplied by cost of equity, which is 25.0435, whole multiplied plus weight of debt, which is 54 lakhs over 81.60 multiplied by cost of debt 7.2, after tax cost of debt, which we have already calculated. This is equals to, let's calculate the numbers. 27.6 divided by 81.6 multiplied by 25.0435, and 54 divided by 81.6 multiplied by 81.6 multiplied by 7.2 plus is equals to 13.2353%. So in case of unlevered, it is 18%, but because of introduction of taxation, your WACC is also going down to 13.2353%. So your WACC in this graph will become 13.53 2353. So hopefully everyone understood. The with taxation says that because of presence of taxation, your debt will generate tax shield, which will increase the value of levered firm, and your WACC will come down because of the benefit of tax shield, where VL will be equals to VU plus T multiplied by D. How to calculate VU? VU is equals to your EBIT minus 1 minus tax, because now you are paying tax, and this is becoming equity earning, divided by your KC, your cost of equity. So first calculate VU and then calculate VL, and then use these numbers to calculate value of equity, value of debt, and cost of equity, where cost of equity will be equals to your RO plus RO minus RD multiplied by 1 minus T into D upon E. And proposition 2 says that your cost of equity will rise, but it will rise at a slower pace, and WACC will go down. And the optimum capital structure is 100% debt. 100% debt we should be introducing as per with taxation, which is not right, because with the debt, new cost will come in. Cost of financial distress, agency cost, bankruptcy cost, that will be taken in the next theory, static trade-off theory. So these theories are in continuation. First without tax, then with tax, and now next part, that is your static trade-off theory. So hopefully the first part, that is with tax, the 5-step method, without tax 5-step method, calculate value of unlevered, which will become value of levered. Both are same because of arbitrage. Then value of equity is equals to value of firm minus value of debt. Then calculate cost of equity. For unlevered, they have already given. For levered, cost of equity is a linear relationship of your debt equity ratio. And then calculate WACC. WACC will be same for both levered and unlevered in case of without taxation. 5-step method. Next, with taxation, it's a 6-step method. First calculate income statement. Then calculate value of overall firm first for unlevered, and then use it for calculating the value of levered. Then calculate value of equity by subtracting value of debt. Then calculate value of cost of equity. Cost of equity is already or will be always there for unlevered firm, because this is the starting point that intercept the point on the y-axis. Calculate cost of equity for levered firm by using the formula RO plus RO minus D multiplied by 1 minus T. Additional, there is a bracket, multiplied by D into T. And then calculate WACC, and for WACC use after tax cost of debt in case of levered firm. WACC of unlevered will be equals to cost of equity only, because it's a 100% equity only. So these 5-step in case of unlevered without tax, and 6-step in case of levered will solve almost all type of question of your theory. So next we will cover the remaining part of the theories, that is static trade-off theory and the pecking order theory, and we will understand about the target capital structure for a company. So thank you so much. Thank you everyone.